Hey traders, welcome back to another video. Thanks for coming back to the channel. If you're new, welcome. In today's video, I'm going to be answering a question from a student in the Pine Script Mastery course. It's a question / suggestion. And the question basically is, this trader wants to develop an indicator that gauges relative volatility or momentum. And so I've written out a script here. This script you see down here looks like a volume indicator, but it's actually calculating all of its values based on the average true range. And so when these bars turn blue or aqua colored, whatever this color is, that means that volatility is picked up in the markets. Now, volatility doesn't discriminate between bullish or bearish. It just means candles have gotten larger. It doesn't mean that momentum is picking up to the upside. In this case, it meant that, but there was also this candle here, which counts as a high volatility candle. And this was a bearish candle. It closed bullish like a pin bar candle, but the swing in this candle was quite wild. And so volatility doesn't necessarily indicate strong momentum, but it can mean that. And so what this other indicator here you see is my ultimate pullback indicator. Now the ultimate pullback indicator, or UPI, is a script that I wrote a few years ago now that I use to trade the Forex and crypto markets primarily. It does work on other markets, but those are the two markets it was specifically designed to trade. Now, this indicator is a proprietary indicator. I don't have the source code public. You can access it through my indicators and strategies course. But for today's example, we don't need to worry about that. All we're worrying about is aligning strong momentum or pickup in volatility with buying pullbacks in a trend continuation strategy. And the student wants to combine this sort of indicator with the UPI to identify higher quality, higher conviction signals trading this trend continuation system. So this trend continuation system doesn't necessarily require strong momentum to the upside to win trades, but that does definitely help. When you're trading a trend continuation system, having the wind at your back, having momentum picking up in the direction of your trade is obviously helpful. If you're trading a consolidation-based system, you probably don't want momentum to pick up. But anyway, for today's example, what I've done here is create a script that meets the student's sort of requirements. And if I turn off this indicator and turn this one on, this indicator here is my UPI with the default settings. And if I bring it to front here, you'll notice that its win rate is only 52%. It's trading a 1-to-1 risk reward profile. And so we have a 25% return and a 23% max drawdown over the past 491 trades. This version of the script is taking every signal on my chart. So here's a losing trade example. You'll notice that this trade was taken while volatility was low, while the ATR was contracting. Now, this looks like a volume indicator, but these columns are actually the ATR value. So this blue line here is a long-term ATR being plotted onto my chart, and these columns is a short-term ATR being plotted onto my chart. So it looks like a volume indicator, but it's actually a ATR-based volatility indicator. And what this other version of the script is doing is taking the same exact signals, except it's only taking them when these bars are blue or volatility has picked up. And you can see the difference here is pretty massive. We've got now a 57% win rate instead of 52%, and our max drawdown is now 8%, and our return is 36%. Now, I did cherry pick this example. The results were not as spectacular on other markets or other timeframes, but this just goes to show that with a bit of creative thinking, there is potential in some of these filters that you can develop. In this case, we're developing a volatility filter. And so before we continue, let me break down the question from the student, and we'll move over to the Pine editor and start coding out this script. So the question is, I was thinking that it would be nice to have an indicator, a histogram or a ribbon of bars to complement the UPI / ultimate pullback strategy. And this indicator will measure the sum of the last X number of bars. The student wants to add up the range of these candles and then compare that range, the sum of that range, to the recent ATR value. And if that range is less than the ATR value, then that would typically mean that the price is in consolidation. Doesn't always mean that, but it can mean that, and it often does, especially after we've had a period of time where the ATR was significantly above average. If that ATR begins to shrink, that typically means that price is consolidating after an impulsive move. And so the student wants an indicator that will print a dull color on the histogram, suggesting that it is not a good time to trade. And if the sum is equal to or larger than the ATR, it will print a brighter color like blue, suggesting that it is a good time to trade. Now, when the student says it is a good time to trade, they mean in the context of trading a pullback system, a trend continuation system, in this case, the UPI. And then they also mentioned my volume, my RVol, relative volume indicator lesson in the mastery course, and they tried to adapt that script to suit their purposes, but they did not succeed. So in today's lesson, I'm going to show you guys how I went about this. So this is the lesson they're talking about, the RVol lesson. And in this lesson, I do exactly what they mentioned in their question, except instead of using volatility or the ATR value to calculate these spikes in volatility, I used relative volume. So these colored bars down here are comparing the volume of the current bar to a moving average of the past, in this case, I'm guessing 100 bars. That would be this lower moving average. And then we apply a threshold, in this case, 2.5. So if a bar prints 2.5 times the 100 period moving average of volume, that's considered a spike in relative volume. And that's what these colored bars are doing. So in today's video, we are going to be doing this exact same thing, but with the ATR value instead of volume. Now, the first thing to note is that there's a problem with this theory of comparing recent price action to the ATR value this way. The problem is if we're adding up and getting the sum of the past 4 bars, and we're including negative numbers, so counting a red bar of 2 pips is -2, and we try to compare that to the ATR, it's not going to work because the ATR is always a positive number. So what we need to do instead is compare the true range of each bar to the ATR. It's almost the same thing, but a slight difference. If we don't do this, then what we'll be doing instead, if we do it this way, is we'll be gauging bullish and bearish momentum instead of just general momentum. Now, there's a time and place for that. You might want to do that with your script. But in this student's example, this is not what they really want to happen. We just want to get a gauge of volatility. We don't care if it's bullish or bearish, because comparing a non-absolute ATR value or a negative number to a positive number will only give an indication of the strength of bullish and bearish volatility, not relative volatility. So in this case, we need to compare apples to apples, not apples to oranges. So that means comparing the true range of recent bars to a longer term ATR value. So in other words, what I think the best way to achieve this is to simply compare a short-term ATR indicator value to a longer-term ATR indicator value. And if the short-term ATR value is larger than the long-term value, then that means we have strong volatility relative to recent volatility, regardless of whether that volatility is bullish or bearish. So let's jump into the Pine editor and I'll show you what I mean. So before we continue, I should break down the formula for calculating the ATR because it's important to know. So the ATR, the true range, is a moving average of each bar on our chart's true range. And the way we calculate a candle's true range is not simply just subtracting the high from the low. That will usually be its true range, but there's 2 other values that are taken into consideration. And so what we're doing is we're getting the maximum value out of these 3 different values. The first is the high minus the low. And because we're subtracting the high from the low, this will always be a positive number. And so that means the next 2 values also need to be positive numbers. And so that's why we use the abs function. The abs function doesn't mean that we have a 6-pack. It means that we are comparing an absolute value, a positive number, to a positive number. And so the next value we check is the current bar's high minus the previous bar's closing price. And then finally, we also compare the current bar's low to the previous bar's closing price. Whichever of these 3 values is the maximum value is our true range for that bar. And so that's why if we just simply add up the past 5 bars and we get in this example, we would have a negative number, and comparing that to the ATR will not give us the information we need or want in this particular context. So what I'm going to do instead is compare a short-term ATR to the long-term ATR, and that should give us a pretty sound indication on recent volatility. There are other methods for doing this, which we may cover in future lessons. We could compare the rate of change. We could compare standard deviations from Bollinger Bands, things like that. But for today's example, we're just going to compare the raw ATR values. So to do that, what I need to do first is get some user input, and I'm going to get 3 values here. The first one is going to be our short-term length, and that will be set to input.integer. I'll give it a title of short-term ATR length and a default value of 5. I can copy this, paste it. Then we're also going to be getting a long-term ATR, which will be 14 by default. These are the values I'm going to start working with. The final input I'm going to get is an RVol threshold, a relative volume threshold. And this is going to be a float input, and I'll just call it RVol threshold. And the default value for this is just going to be 1. And I'll explain what this does once we have our code written. So now that we have our user inputs, the next thing we need to do is get our indicator values. In this case, we need two ATR values. So ATR1 is going to be set to TA.ATR, and we'll pass in our first length input. And then the second ATR value requires a second length input. Now we just need to simply compare these two inputs to each other. So here I'll just say generate rvol alert / signal. And I'll create a new variable here called rvol alert equals, and then we're going to check if the short-term ATR value, ATR1, is greater than ATR2. But I'm also going to multiply ATR2 by our rvol threshold. So by default, this will just be 1. So 1 times the 14 period ATR, but we can change that in the settings menu if we want to detect higher volatility candles. So the next thing I'm going to do is get our volatility color, and that will be set to, do we have an rvol alert? If so, we want to set the color.color.aqua. Otherwise, if we do not have an rvol alert, we need to set this to a dull color. That's what the student wanted the script to do. Now, in the example I showed at the beginning of this video, I actually changed the color based on the candle, whether it was bullish or bearish. So my code originally looked like this. If the close is above the open, we set the bar to green. Otherwise, we set it to red. Now, because we're not necessarily analyzing the bars themselves, we can just set this to color.gray and keep the script a bit simpler. So we'll do that for now. The final thing we need to do here, well, almost the final thing would be to generate alerts. But before we do that, we need to draw the data to the chart. So I'm going to use 3 plot functions here. The first one is going to just plot the short-term ATR value. So I'll title this plot short-term ATR, but I'm going to style this plot as a column. I think it makes this indicator a bit more intuitive to read. So I need to set the style to plot.style_columns, and I'll set the color to our vol color variable, this guy here. The next plot is going to be our longer term ATR value. So I'll title this long-term ATR. The style is just going to be a regular plot, so we don't need to specify the style, but we do need to give it a color. I'll set the color, in this case, to color.black. The final plot we're going to draw here is the ATR, the long-term ATR, multiplied by our rvol threshold. And I'll title this rvol threshold, and I'll give this one a color of color.blue. I can get rid of this plot NA. And now I can get rid of this. And when I save my script, we should be getting our volatility indicator plotting onto the chart. And as I mentioned at the beginning of this lesson, what this script is doing is these bars here is actually the short-term ATR value. So the 5-period ATR value being compared to our blue line, which is just a regular 14-period ATR value. And whenever the short-term ATR is greater than the long-term ATR, we have volatility picking up. And we can obviously tweak these values here if we want to. I could set that to 3 and this to 20, and we'll get a more sensitive volatility detector. Or I could set this to 14 and this to 100. And now we're getting a more sustained, longer term indication of relative volatility. And the final thing before I wrap up this script is let's generate alerts. So for this, I'm just going to use the old school alert condition function. And the condition for this alert is just going to be our rvol alert Boolean value. The title is going to be rvol alert, and the message will be momentum has increased on, and then I'll pass in the ticker placeholder. This will be replaced with whatever market we're on, in this case, euro dollar. Save my code. And now if we come up to the alert box and I select my script, I can select the rvol alert, set up my alert settings how I want. The next time the chart prints a candle that has greater volatility than the recent longer term volatility, I'll get an alert sent to my phone or whatever. And that's pretty much it for this script. It doesn't do exactly what the student was trying to do, but I think, in my personal opinion, as a trader and coder, this I think is a better way to do the same thing. Now, there's ways we could improve this indicator. We could add confluence to it. We could check rate of change values. We could check volume as well. We could incorporate volume. If volume is elevated as well as volatility, that's often an indication of an impending reversal most of the time. But in this case, we want to combine this with the UPI. And if I set this back to its default values, it would mean that we only take trades that the system generates when volatility is elevated. So we would not take this losing trade, because volatility was contracting, or in other words, price was consolidating. And if I keep going back here, this warning label here just means that this trade hit its take profit and its stop loss on the same bar. So if I zoom in, you can see that we entered long on this bar's open, and then this wick hit our stop loss, but the bar also hit our take profit. Now in this case, I would assume that price hit our stop loss and then went up to hit our take profit. So this was a losing trade, but you never really know. It's possible this opened, came up, hit our take profit, came back down. We were already out of our trade, or our stop loss was at break even if we were trading 2 positions, which is typically how I trade this strategy. And this would have been a winning trade or a one target winning trade. The only way to know for sure would be to drop down to a lower time frame and see how this bar unfolded. But that's outside the scope of today's lesson. I just wanted to point that out in case you're wondering what this giant yellow warning label is. But if we go back here, here's another trade we wouldn't take. This trade happened to win, but it occurred during contracting volatility. Same with this trade. So you are going to give up winning trades. That's always the case. Whenever you introduce a filter to a system, it's also going to eliminate winning trades. That's just the nature of the game. But as we saw at the start of the lesson, when I compared this indicator's default settings to this version of the indicator, which has exactly the same settings, except I copy and pasted this code here into the source code of the original UPI. And all I did was add one more check to our market condition filters that checks if volatility is elevated. And to show you that that was the case, to be fully transparent, let's copy this code. I'll just paste it into a notepad. Then I'll delete this test indicator off my chart, open up the source code to the UPI, and then copy all of this code. It's about 800 lines of code, create a new indicator, save this, and I'll just call this RVol test. I'll add RVol to the end of my indicator label, save that code, add it to my chart, hide the original script. It does take a moment to compile because it's such a large script, but it should be done soon. There we go. Now if I come into the settings menu and I turn on the draw backtester results, we'll have our backtester results being drawn down here, and our trade win metrics, win rate metrics, and so on, the stats of the system. And now if I hide both scripts, you can see the return metrics are identical because they are exactly the same script code. But now if I open up the source code to the script we just created and I copy just this code, this is all we need. We just need our user inputs, our indicator values, and then to compare that indicator value to our RVol threshold. If I come up to the RVol script and I scroll down to where the script detects market conditions, which is here, if I paste this in and I simply add this check here, so we only have a valid long entry if all of these conditions are met, and there's a lot of them. So if our RVol alert condition that we just created, if this bar is blue or aqua, and I'll add it to the short trades as well, that's literally the only changes I've made to the script. Now when I save our code, watch our win rate metrics and our simulated backtesting return metrics. Bam. We have significantly changed the metrics of this strategy. We've reduced our trade quantity quite a bit, more than half, I believe. We had nearly 500 trades with this version. So we've halved our trade frequency, which means we've halved our commission costs. We've also halved our drawdown, over halved. I think the drawdown was 25%, 23%. So we've significantly reduced our drawdown. We've modestly increased our return. So we had a 25% return. We have an extra 10% or 11% with this version of the script. And we achieve this jump in performance simply by introducing a new filter to the system that only takes trades when volatility is increased. And the filter couldn't be more simple. I mean, we're just comparing a short-term ATR value to a long-term ATR value. We could do that manually. All we'd need to do is add 2 average true range indicators to our chart. I can merge these together, set one of them to 5 and one of them to 14. And I need to merge the scales to the right. There we go. And basically this script is doing exactly what this script is doing. Whenever this red line is above the blue line, we are permitted to take trades. All we've done is pretty it up a little bit, make it look a little more interesting, a little bit more intuitive. But anyway, that will do it for today's lesson. I hope you found this interesting. As always, the source code will be below. The source code to the ultimate pullback indicator will not be below because I've spent hundreds and hundreds of hours working on that script. So that's a private script, unfortunately. You can get the source code for that script on my website in my strategies and indicators course. It's not a cheap course because it includes the source code to every script I've ever created, including detailed lessons breaking down the code. So I put a lot of work into that. Lots of hours was sunk into that. But if you can't afford that or you're not interested in that course, I do have a public indicator called the aggressive pullback indicator, which is what the UPI was originally based on. And the source code to this indicator is actually public. It's not public on TradingView, but it is up on my blog. So I'll leave a link to my blog below. And this is a very, very simplified version, the original incarnation of the ultimate pullback indicator. So if you're curious about how to create a script that detects simple pullbacks above or below a moving average, using the moving average as a trend filter, go and check this script out. There'll be a link in the video description and in the pinned comment below. And with all that out of the way, I wish you the absolute best with your trading. Have a fantastic weekend. If you're watching this when this releases, don't forget to join our free mailing list below. I send out an email every Wednesday giving you a new tip, a new book I've read, a new podcast I've discovered, or a YouTube channel that I like. And I just share with you guys anything that I've found valuable in my own trading every Wednesday. No marketing, no BS, just pure value for you guys. So go and check that out. If you're interested, if you want to learn Pine Script, obviously you can check out my courses. They're at pinescriptmastery.com. We have the free basics course as well. So plenty of free stuff out there to sink your teeth into. If you're a beginner or you can't currently afford the courses or you're just not interested, at least go and check out the free stuff. There's tons of it out there. Hours and hours and hours of free content on my website, my blog, my podcast. I get pretty bored trading. I trade the daily chart these days primarily. I do discretionary trade and trade some shorter term systems, but the bulk of my trading now is done on the daily time frame. So I have a lot of free time between bar closes. So I tend to pump out a lot of content. So go and check that out. I'll speak with you in the next video. Take care. I love you. Thank you for being here, and I'll speak with you soon. Goodbye.